Capitalizing on the U.S. China tariff war, a market-based approach. The U.S. China tariff war, which began in earnest in 2018, has continued to shape the global economy, introducing both challenges and opportunities for savvy investors. While the trade war has resulted in higher costs, market volatility, and significant shifts in global supply chains, it has also created potential avenues for capitalizing on the evolving landscape. Understanding how to navigate these changes in the market can provide investors with significant opportunities, especially in sectors directly impacted by tariffs, supply chain shifts, and changing trade dynamics. Understanding the context of the tariff war. The U.S.-China trade war centers on tariffs and other trade barriers imposed by both countries. The U.S. has levied tariffs on hundreds of billions of dollars worth of Chinese goods, citing unfair trade practices and intellectual property theft. In retaliation, China imposed tariffs on U.S. goods. This tit-for-tat escalation has disrupted global trade patterns and affected both countries' economies, as well as economies that are heavily integrated into the global supply chain. The tariff dispute has caused uncertainty in various sectors, agriculture, technology, manufacturing, and consumer goods being among the most prominent. However, for investors, this volatility and disruption can be leveraged with careful analysis and strategy. Sector-specific strategies. Technology and semiconductor sector. The technology sector, particularly companies with heavy exposure to China, has been one of the most affected by the tariff war. Chinese tech giants, such as Huawei, have faced restrictions on buying American technology, particularly semiconductors and software. The U.S. imposed export bans on several high-tech products, such as advanced semiconductors, creating gaps in the supply chain. Investment opportunity. Investors can capitalize on these disruptions by focusing on companies that are less exposed to Chinese markets or those that stand to benefit from the shift in the supply chain. For instance, U.S.-based semiconductor manufacturers like NVIDIA, Intel, or Micron Technology could benefit from the demand for homegrown alternatives to Chinese technology. Additionally, companies involved in reshoring technology manufacturing to the U.S. could see significant growth. Agriculture and commodities. One of the most immediate effects of the tariff war has been felt by the agriculture sector. China, a major consumer of U.S. agricultural products, reduced its purchases of American soybeans, pork, and other goods in retaliation for U.S. tariffs. As a result, American farmers were hit hard by reduced exports. Investment opportunity. A potential strategy is to focus on agricultural commodities that could experience volatility due to these shifting trade patterns. For example, U.S. farmers could pivot to new markets, such as Southeast Asia, Europe, and Latin America. Investors can look for agricultural ETFs or stocks tied to companies that benefit from these alternative exports, or those companies poised to capitalize on new free trade agreements. Additionally, agricultural machinery companies like Deere & Company could be well-positioned to profit from increased demand as global supply chains reorganize. Manufacturing and supply chains. Tariffs have incentivized companies to relocate manufacturing operations out of China, especially in industries where tariffs have significantly increased the cost of goods. Countries like Vietnam, India, and Mexico have become prime alternatives for companies seeking to mitigate tariffs while maintaining cost efficiency. Investment opportunity. Companies that assist in the relocation of manufacturing operations could see a surge in demand. This includes logistics companies, international trade consultants, and firms providing automation solutions for new factories in alternative locations. For instance, logistics companies such as FedEx and UPS are integral to the shifting supply chains, benefiting from increased trade volume between the U.S. and other countries. Additionally, investing in countries like Vietnam, which is a direct beneficiary of supply chain shifts, could be a strategic move. Consumer goods and retail. The tariff war has affected the pricing of consumer goods, as the cost of imported goods rises due to tariffs. U.S. retailers selling Chinese-made products saw their margins squeezed as tariffs increased. However, consumer behavior during trade disputes has been interesting to track. While some companies can absorb the cost, others pass it on to consumers. Investment opportunity. There's an opportunity in companies that are adapting their supply chains or shifting production to other countries. For example, Apple has been shifting some of its production out of China to countries like India, Retailers that have successfully adapted to these changes, such as Walmart and Costco, which source from diverse suppliers, could gain an edge in the post-tariff world. Similarly, private label companies, which source their products from a range of locations, may be better positioned to deal with tariff fluctuations and pass on cost savings to consumers. Strategic use of ETFs and index funds. For investors who do not want to pick individual stocks, but still wish to capitalize on the changes wrought by the trade war, exchange-traded funds, ETFs, and index funds are excellent options. Several ETFs target specific sectors or countries impacted by tariffs, making it easier for investors to gain exposure without the complexities of individual stock picking. U.S. China trade war-focused ETFs. Some ETFs are specifically designed to take advantage of the trade war's effects, such as the VanEck Vector Semiconductor ETF SMH or the iShares MSCI Emerging Markets ETF EM. These funds may focus on sectors like semiconductors, which benefit from a reduction in Chinese imports of U.S. chips, or emerging market funds that capture gains from the shifting supply chain. Agriculture and commodities ETFs. As the agricultural sector faces disruptions, commodity ETFs like Tariff Corn Fund Corn or Invesco DB Agriculture Fund DBA might be a good hedge against rising commodity prices due to supply chain disruptions. These funds can help investors gain exposure to broader agricultural trends and fluctuations tied to the tariff wars. Global trade ETFs. As companies look to shift their supply chains and diversify their exposure to China, global trade ETFs, such as SPDR S&P Global Infrastructure ETF GII or Global X MSCI China ETF CHN, can provide a broader international scope to capitalize on global trade shifts. Currency and commodity markets. Currency trading. Currency markets are another area where the U.S. China tariff war has had a significant effect. As tariffs are imposed, the value of the Chinese yuan fluctuates relative to the U.S. dollar. Forex traders can capitalize on these fluctuations by trading the yuan against the U.S. dollar to Chinese yuan. Investors can also track emerging market currencies that may benefit from reduced exposure to the U.S.-China trade conflict. Commodities. Tariffs and trade disruptions impact the global flow of raw materials, often leading to price increases in some areas and drops in others. Metals, particularly those used in electronics, such as rare earth metals, have been subject to tariff changes, impacting the price of these materials. Investment opportunity. Commodity traders and investors may find opportunities in metals such as copper, lithium, and rare earth elements, which have seen demand rise as countries diversify their supply sources away from China. Investing in ETFs that track these commodities or direct investments in mining companies can be strategic. Key takeaways. The future of U.S. China trade. While the future of the U.S. China tariff war remains uncertain, the effect on the global economy will continue to unfold. Investors who carefully monitor the shifting supply chains, sector-specific impacts, and broader global trade dynamics can capitalize on the disruptions caused by the trade war. By focusing on sectors poised to benefit from these changes, using ETFs for diversified exposure, and paying attention to currency and commodity fluctuations, savvy investors can navigate this volatile environment successfully. Capitalizing on the U.S.-China tariff war requires an understanding of the broader economic shifts. But for those who can identify opportunities amidst the chaos, there are significant rewards to be had.